Okay. Good morning then, ladies and gentlemen. Could I welcome you to the Local Pension Fund Committee? The meeting is being broadcast live YouTube, and it will also be available for viewing after this meeting. Due to the current situation, this meeting is taking place virtually with members of the committee, along with the officers presenting reports joining online. Can I ask all members and officers have their microphone on mute until they wish or are invited to speak? And when you're speaking, please make sure your video is turned on as well. First of all, could I ask those present and those giving the reports to introduce themselves to those watching online? And if I could start with the county councillors present. Tom?
Right, my name's Tom Barclay. I'm County Councillor for Syston Ridgeway.
Peter?
Hi, my name's Peter Bedford. I'm the County Councillor for Markfield, Desford and Thornton.
And Max? Or is Max
Mr.
giving
Hudson,
apologies? Okay, it's fine. Thank you very much. If I turn to Leicester City Council.
Chair, you forgot me.
I've forgotten you?
Yeah. Right.
My sincere apologies. I feel most embarrassed. Please introduce yourself.
Sarah Hill, County Councillor, Market Harbour East, or Harbour East.
I'm really sorry, Sarah. That was my fault.
No
if I
problem.
turn to the City Council. Mr. Kevin?
Yeah, it's Councillor Ratilal Govind, representing the City of Leicester.
Thank you. Do I presume that Adam Clark is sending his apologies?
I'm present, Peter.
Oh, right.
Hi, I'm Councillor
Sorry,
Adam Clark.
Yeah, Adam, I can't see you on screen, that's all.
No worries, I'm hiding in a corner. Councillor Adam Clark, I'm Councillor for Ayleston, Deputy City Mayor.
All right. For the District Council representatives.
Councillor Mellies Graham, Milton Borough Council. Can you hear me?
Yes, thanks, Melise.
Thank you.
And Councillor Frost? No, Councillor Frost. Moving on to the university representatives.
Yeah, Zubair Limada from De Montfort University.
Okay, good morning to you. And to the staff representatives.
Nick Booth, staff representative.
Jackie Dean, staff representative.
And is Mr. Ashley Wilson with us?
I can see him online. I'm not sure if he's muted, if he's trying to talk.
Well, he just to say to the general public, he is staff representative. So could I then turn to the minutes of the meeting held on the 27th of November? I propose that these minutes of the meeting held on the 27th of December are taken as read, confirmed and signed. Is everyone in agreement?
In agreement.
Yes, Chair.
Thank you. Question time. I have received no questions. Questions asked by members under Standing Order 7375. I've received no questions from members. I have not been notified of any urgent items to be brought forward on the agenda. Declarations of interest. Could I ask members, do you have any declaration of interest to declare?
No, Chair.
Okay, thank you. So then if we move on to the substantial part of the agenda, and that is on item 6, the funding strategy statement, employer risk and assist. Could I welcome Ian. And Ian, before you start, you could just say to members of the public who might be watching what your position is also.
Thank you, Chair. I'm Ian Howe. I'm Pensions Manager for the Leicestershire Pension Fund.
Okay, does anybody have any well, I was going to say any questions or comments. No, I'll have to for you to give your report first.
Certainly, yes, sure. I'll start. So, good morning, everybody. Thank you for allowing me to present the report. This is a report about some regulation changes that came in from September 2020 that introduced opportunity for pension funds to allow 3 new areas into their gift, if you like, in terms of how they deal with employers who are potentially exiting the scheme, and to effectively assist the fund in managing 2 of those, and one is for employers to request reviews of their employer rates outside of the valuation period. What I'll do is if I can go kind of straight into the report and talk about the 3 key areas and then the policy that the fund is proposing to adopt. The first change is where employers can now request a review of their employer contribution rates outside of the fund valuation. The key points within this are in points 12 to 19 in the report. I think the key point really is for the fund's view here is not to allow this as a standard. This isn't something that we would propose to allow, other than in one exceptional circumstance, and that is if the employer is getting into genuine financial difficulty, and if there is an opportunity to allow a review of the rate to assist the employer, that is something that the fund would consider, as long as all the other areas in the report are met. So that's the recommendation for the first change, which is the review of employer contributions. The second one is spreading exit payments. Effectively, what happens when an employer leaves the scheme, the fund liaises with the actuary to determine what we call a cessation termination value, which effectively is an amount of money that the employer then pays to the fund in order that they've met their future liability effectively, and then they can walk away. Normally, the employer will pay that as a single payment, but this is introducing the opportunity to spread that exit payment. So effectively spread the payment to assist the employer in making payment. Again, the fund will only allow this really in one exceptional circumstance, and again, that is if there is genuine financial difficulty, and this option increases the chance of repayment, and that's detailed in the report from points 22 to 29. And then the third point is a new area, really. It's in a kind of a fairly new concept. This is something called a deferred debt agreement. It's similar in nature to the second version, which is spreading the exit payment. But the key difference here is that there is not actually a cessation crystallization event. So effectively what that means is the employer, although it has no longer active members, remains invested with the fund, so its deficit could increase or decrease. This is our least favoured route. We'd much prefer the spreading exit payment, but again, in the exceptional circumstance that this would assist an employer and avoid potentially an employer going into bankruptcy by even with the spreading option, this is something the fund will consider and allow. Again, all the detail is included in the report from points 34 to 39. The other point I wish to make is because this is a fund policy, we will have to make changes to the funding strategy statement, which is attached within the report. And that would also have to be consulted upon with the fund employers before the final policy is established. So this report is effectively asking committee for approval of the amendments to those three areas within the funding strategy statement, and also to allow the fund to commence a consultation with the employers, and then we will bring back the final version to committee in future 2021. Thank you, Chair.
Okay, thank you very much, Ian. Does anybody have any questions or comments?
I can see a hand from Nick Booth, Chair. Are you okay for me to ask Nick?
Yes, please. I'm having problems on the screen because I can.
Sure.
It's not showing people up as it should do. I can see Nick's now with his hand up. So over to you, Nick.
Okay. Thanks, Chair. Thanks, Ian. Just a quick question, really. As the sort of total pension liabilities won't be known for perhaps another 80 years, if you have a 30-year-old in the system who has a widow who's 10 years younger who lives to be 100, presumably the calculation of the exit debt is done on a prudent manner so that the fund shouldn't lose out.
Yes, Nick, you're correct. What happens, Nick, to expand on your point, is when an employer terminates, the fund provides all the information to the actuary, which we have obviously right to do within the GDPR rules as they work closely with us in this instance. And that will include certain data to allow the actuary to assess the potential cost for those ongoing pensions, including potential for spouses benefits as well, Nick. So it's based on information on a kind of an employer by employer basis, based on that data within that fund for that employer.
Okay.
Is that okay, Nick?
Yeah, okay.
Okay.
Thank you.
Tom, you've got a question. Tom?
You're on mute, Mr. Barclay.
Okay, Tom.
I can see Zubair's got his hand up.
Right. If I could move to Zubair then, please.
Thank you, Chair. Just one comment and one question. Apologies, I've just got the joys of homeschooling. Just one sec. Sorry about that. Ian, thank you very much, Ian. Thanks. I just wanted to say, going through the paper, I just wanted to say thank you. I read through the paper and I did find it quite easy and to follow, and it makes sense. So I appreciate that. I just had one question. The consultation, in terms of going out for 4 weeks, any idea when you plan to launch that consultation?
Thank you, Zubair. Yes. Effectively, I was planning on starting it from the 1st of February, as long as committee are happy with the recommendation. That was to try and allow as many of the employers opportunity to review that, so avoiding things like school holidays and things of that nature, Zubair.
Okay, thank you.
Okay. Thanks, Zubair. Does that answer your question? Well, yeah, it does. You've gone on mute. Tom, your screen's frozen. Are you able to listen to us?
Yeah, I can hear everything. I'm just having a bit of trouble with the screen. Actually, my question's been answered, so that's fine.
Okay. Right, I can see this. Zubair, if you could lower your hand, because thanks, because then I can see if there aren't anybody else indicating they wanted to ask anything. So, pardon me. So could I ask if you approve the draft funding strategy statement in relation to changes on employer risks and exits for consultation with the fund's employers? Is that agreed?
Agreed.
Agreed, yes, agreed.
Okay, thank you very much. Then we're asked to note that a further report will be submitted to the committee presenting the outcome of the consultation and seek your final approval for this document later in the year.
Agreed, Chair.
Thank you. If I could move on then to agenda item 7, which is the draft responsible investment plan for this year. That's on pages 69 to 98 in your pack. And I will hand over then to Bulesh.
Good morning all, I'm Bulesh Katra, representing Leicestershire County Council. So the purpose of this report is a continuation of our 2020 Responsible Investment Plan, which you will remember was our first investment plan, which we brought to the January committee last year in 2020. So just a little bit of background here, covering points 2 to 6. You'll note that in point 4 we noticed that we do say that this is an essential part of the fund's approach to investing, and in that manner we incorporate responsible investing into our manager selection, and we kind of redline via central those investment managers who can't meet the minimum standards. We do also review funds. You'll note at our last meeting we had LaSalle in at the quarterly meeting in November, and we had slides within there to review their RI stance as well. So point 6 notes that we have developed a 2021 RI plan with LGPS Central's in-house team, and that's what this paper is about. We'll see that on page 72 onwards. Point 7 brings up the UK Stewardship Code 2020. Now this is a code that has existed for a while in a different guise. So it was the 2012 code previously. The 2020 code improves the expectations for pension funds as ourselves on reviewing managers and their stewardship responsibilities. So it kind of makes it harder and raises the standard, etc. We'll come on to that, and we've built it into our plan. So moving over to point 8, it highlights again what we just mentioned regarding the increase in ambition compared to the old code. What I've done in point 9 is copy pasted a table, if you like, which highlights the 12 principles for the UK Stewardship Code 2020. Just not to pass over all of those, but if you look at point 8, for example, signatories, so that will be the pension fund, will monitor and hold to account investment managers and service providers. Now, this will become increasingly easier over time as we transition more managers over to central, so we've got fewer managers to monitor, if you like. Point 10, signatories, where necessary, participate in collaborative engagement to influence issuers. So we do this currently, and we're doing this more and more as time goes on. So we do this via LGPS Central's RI team and our membership of the local authority pension fund forum, for example. The last one here I'd want to pick up on is point 11, for example. Signatories, where necessary, escalate stewardship activities to influence issuers. We include within our quarterly stakeholder reports examples where we've done this, and it includes companies that we, as the pension fund, hold within our investments. Moving on to the next few points, what we've done here is we've built on our current investment RI plan, if you like, and we've picked up on the elements that we hadn't quite completed, and we've included them into the 2021 plan. And we've also carried over a load of standing items which we were bringing to committee every quarter. So we've not included them in the table, but that includes things like the bringing to every quarterly meeting, the quarterly stewardship report, the voting metrics for all our listed equity investments, which aren't shown in the table, but they are standing items going forward. The table you'll see on page 72 is our proposed draft plan, and we've split it by quarter, similar to last year. You'll be familiar with the table in the sense that it's a table that we use every quarter, and we report against each of the items and their progress going forward. So rather than read through them all, I'll pick up on a couple of new ones, and I can take questions at any point if you feel you want to. So we've got two elements of RI training. We've decided that it'd be a good idea to take one early in the year and one later in the year, so Q1 and Q3, you'll note. Content to be provided closer to the time. We've got a review of the stewardship code. So we mentioned earlier that the 2020 code is out there, and what we really need to do is understand what we need to do to be able to sign up to that code, how onerous it'll become, and if it's right. So we've got a marker in here to say we'll review that. As a point of note, within our central pools of 8 partner funds, we only currently have one partner fund who is a signatory to that code. A number of our colleagues in the other funds are considering it just like we are. You'll notice in Q3 we've got our climate risk report again. So that's similar to last year. We brought it to the November committee. We're just planning to bring it into committee slightly earlier this time round, just to give us more time to use it with Hyman's and incorporate its findings a bit deeper, if you like. And then we've got an item right at the end, which is a review of good governance and SAB, and it's a TBC because we're still waiting on recommendations to come out from good governance. That's all I've got to say for that report, but I'm happy to take questions.
Okay, thank you very much, Bullish. Does it have anybody have questions for Bullish? Marlies, you have.
You're on mute, Councillor Graham.
Marlies, you'll have to start again. You're on mute.
Right, can you hear me now?
Yes, excellent.
I have two, really. One is about tax paying. They have to be responsible taxpayers. Now, there is a difference between avoidance and evasion. And I do think it's important. In a way, one wants people who avoid paying tax, but one certainly doesn't want people who evade paying tax. And I think that should be made clearer. The second one is on the report on basically climate change. It's been written by a vegan and basically condemns livestock farming, which is a crucial part of, certainly if you come from Melton Mowbray, which is pork pies and Stilton cheese, livestock farming is incredibly important. And the first part of that report by Hermes condemns livestock farming. And I would find it very hard to go along with that. I don't know if you've got any comments. Thank you.
I'll attempt to pick up the two separately. So your first one regarding tax, we have LGPS Central's RI team, and one of the 4 areas that they cover every quarter, and they've carried these over from last year because they felt that they were the right 4 elements, includes a line called fair tax. So I think that covers that section in the sense that, evasion versus avoidance, but it's fair tax. It's looking at entities who choose to domicile themselves in certain jurisdictions to avoid tax or pay less tax, and it's how we move as a collective and kind of influence fairer tax. Does that help answer your first question? Still on mute, Councillor Graham.
Sorry, I went back to mute again. Sorry. No, it doesn't really, because I feel that tax is set by the relevant governments. And it's all very well saying Amazon don't pay enough tax. But nobody goes along to a government saying, look, I'm not paying enough tax. Can you please tax me some more? You play within the rules that are given by central government. And certainly if you evade it, there is absolutely no excuse. But I rather admire people who avoid it.
I think that's slightly more difficult to answer, and it'd certainly be one that I'd want to put forward to our central team to see what their views are. And I can take that one over to them and get back to you accordingly for that. Coming back to your second question regarding livestock farming, so you've had a look at the climate risk report, and you've gleaned from that the livestock farming element and the effect on the climate. Now, it's fair to say that the report is guidance. We certainly won't be able to influence investment managers to move in and out of certain investments, based on a single item alone. But I think that there's probably wider consultation and knowledge to be built around the area. Like you say, there's far-reaching impacts on whole communities, etc. So, it's a discussion. It's certainly not a given that if there's an impact on livestock that we, as a fund, we divest. We're always in the role of engagement before divesting, as you know.
Thank you. How can one take part in that discussion? Because it is a damning report on the future of livestock farming, and I should probably declare an interest, having a small farm, a few sheep on it. But it is a crucial part of the economy of this country. And
I think the right way to do that is when we bring in central and put across our views as as committee members. You're rightfully allowed to do so. They will be joining at our Q1 meeting, so I'd hold that question, and if we want to bring something to their attention beforehand, we can still do that.
That's very kind. Thank you very much.
I've got a number of people who want to ask questions, but before I ask them, could I also say to members, I'm in the same position as Molly's in that I guess I should declare an interest, and although I don't directly have livestock. That I don't own livestock. I've got livestock on my land. The problem, even if I didn't have livestock, what members have to understand, or those doing the reports, is that farming is interconnected. And just because I grow, let's say, cereals, it is dependent to a large extent on those who have got animals. And so you can't separate one from the other. It's all integrated. However, I'm declaring an interest just in the same way. But could I first of all go to you, Adam? You have your hand raised.
Thank you, Chair. I declare that I occasionally enjoy a Melton Mowbray pork pie, and I think the debate is incredibly salient. I think because we do need to recognise the impact on the economy that any actions that might take in trying to combat climate change. But my question is around our citing of any forthcoming parliamentary legislation and anything that might come forward as a result of COP26 that might impact on the programme that you've put in front of us and the programme beyond, because I think this year it will be incredibly fast moving in terms of how we respond to climate change, and investment will be very much in the forefront, I think, from campaigners and politicians' point of view.
Okay, Polish?
Yeah.
All right. Sarah, you have your hand raised.
Yeah, I suggest Malisi listens to the food programme that was on Radio 4 this last weekend. They're not saying everybody's got to stop eating meat. They're saying you should maybe eat less, particularly in America, where they don't have our nice grass-fed cows and sheep, where they do stuff in feedlots, which is actually horrendous for a whole range of reasons. And I think I accept your point. It is, as way we farm currently, essential we have livestock. But I think there's a difference between eating better meat and eating slightly less of it than going vegan. And I think that's the nuance that maybe you didn't pick up from the report. You know, as somebody who eats only organic meat, I'm not eating stuff off a feedlot in America that you might get in a fast food place, or chicken that's been imported from Thailand, for the sake of argument. And I think that maybe is what it's driving at. Our decisions as consumers make a difference. And if you're going to buy cheap, poorly raised stuff that's got a horrendous carbon footprint, then we need to think about that. That's all I wanted to say, Chair. Thank you.
Yeah. Could I turn to you, Tom? You have your hand raised.
Yeah, it's just a comment, really. I think things are evolving. Without being inflammatory, I think we need to take a balanced view. Clearly, this report is evolving. It's moving towards achieving what we need. We've got to remember also that we do have a duty to get some return so we can pay the pension funds out. And whereas I think industry and governance and everything else is going to move very fast towards climate change and addressing, for future generations, I just think we have to be aware that it isn't going to happen overnight. Everybody wants to move in the right direction and will make every effort to. That's the only comment I've got to make.
Okay. Thanks. Nick, you have your hand up. Nick Booth?
Yeah, thanks, Chair. Just to point out, yes, I declare an interest. I like lamb cutlets as well, and no intention of not continuing to enjoy them. But there are things that can be done, as Dr. Hill has suggested, that can improve the carbon footprint without stopping your enjoyment of those. Trust the science. I think there's, as Councillor Clark says, things are going to happen, and there'll be things that can do to stop us reducing climate impact, but still enjoying our lamb cutlets. And then the other point is, as a public sector pension fund, we rely on the government to provide funding, and the government needs funding from its tax revenues. So from the point of view of the long-term security of the fund, we should encourage strongly that the government manages to get fair tax coming forward. So I personally do not praise those that avoid tax, even if completely legally, and I support the report and the approach for LGPS Central. That's all I have to say.
Thanks, Nick. Claire, you have a comment.
Thank you, Chair. Just for introduction, for those of you who don't know me, I'm an independent advisor to the Leicestershire Pension Fund. I just wanted to respond to Councillor Clark's question around the COP26 and the sort of expected direction of government and expectations of the fund around the climate change. And I think the fund is we've seen the plans coming through last year's and this year's, and I think is moving in the right direction, which is good. I would point to the element of the plan under Q1 21-22, which is what we call the TCFD, the Task Force on Climate-Related Financial Disclosure. Government has been consulting around making such reporting on TCFD compulsory for particularly large pension funds in the private sector. But I think there is an expectation that may well become compulsory for local government funds earlier. So I think that the fund is getting ready, and that the first sort of carbon report that was done last year is a good step. I think what I would like to see, and I would suggest that the RI and the TCFD and the climate reporting coming together with the broader strategy review, so the two are more integrated. That would be my sort of suggestion for future direction. But I think that's being built into the plan as well. So thank you.
It's helpful. Thank you.
Okay. I can't see anybody else indicating to me. So it's recommended then, as you'll see, it's recommended that the committee approves the Responsible Investment Plan 2021. Could I ask you if that's agreed?
Agreed.
Okay, thank you very much then. And then we move on to the last substantial item on the agenda, and that's the annual review of the asset strategy and structure. And that's set out on pages 99 to 162. Could I then welcome Andy Green and Emma McClarkin from Hyman's, who will set out the report to us. Sorry, that was mine blasting away.
Mr. Chair, that seemed like a wonderful introduction to us. Thank you. Andy Green from Hyman's Investment Consultant to the fund.
This came straight on.
So I think we're on mute now. So Kat's just put up a set of slides. I've just put up a set of slides which are really a summary of the key components and recommendations in our paper. So rather than actually sort of go through the paper, which I appreciate is quite long because there's a lot of detail on some of the aspects, I thought we'd use this just as a document to work through to just cover the main items. Obviously happy to take any questions as we go through, or indeed we'll have a chance to sort of pick up the overall summary at the end of that. So excuse me. Kat, do you want to just move on to the next slide? Thank you. So this first slide just gives you an outline of the current strategy. The asset allocation at any point in time will obviously not be in line with the target weight through, in part, market movements. We'll talk a little bit about that as we go through this, but also the year-to-year changes in the strategy and the implementation of those changes. And one of the things that we have at the moment is a move to switch more of the assets to use LGPS central funds, and therefore some of the strategic changes that you're making, the actual implementation of them, become a little bit dependent upon the timing of LGPS central launching those funds. And again, I'll bring that out just as we talk through this. Quick backdrop just in terms of the broad objectives, and we've just got sort of the highlights of those summarised on the left in terms of the objective of delivering a long-term strategy consistent with stable and affordable contributions and removing any shortfall. There is a key sort of element in that that we are looking at long-term returns. We're not trying to second guess short-term markets, and frankly last year is a perfect example of how that can be extremely difficult. Congratulations to anybody who got the timing perfectly right, but markets don't always do exactly what you expect them to do when you expect them to do it. So you are looking at the long-term strategy, and that's what this discussion is about, rather than the tactics your managers, which are active managers, will implement the more shorter-term decisions. But the second part of that, in the objective that I think is important, is that stable and affordable contributions. There's two components to that. The affordable means we do need to generate a high enough return. And there was a comment in some of the earlier discussion about the need to invest to earn return. You can't close off all risks. But to the extent that you can, you want to do that in a stable way to achieve long-term returns. And that's quite interesting if one just puts that into the context of some of the discussion you've just had on responsible investment. And I agree with Claire, there's an integration of responsible investment with strategy to the extent that stable costs will come from sustainable and stable returns. And one of the important aspects, therefore, of investing is to achieve sustainable investments through time. And that sustainability, undoubtedly, the likes of climate change and responsible investment are going to come into play on that in due course. And again, we'll pick that up briefly as we go through. The table that I've included on this page and we have in the paper is a little bit of a different characterization of the assets to that we've used previously on the fund. And we've grouped the assets into three categories. What we've referred to as growth assets, income assets, and protection assets. And simplistically, we're bucketing assets in a way of the different characteristics and expectations from those assets. Growth assets, you would expect a higher return, but you are also undoubtedly going to get some volatility in that return that comes through associated with it. And listed equities, a prime example. There is plenty of upside, but from time to time, you are going to also have downside associated with that. The markets are volatile. Income assets, most of the return is assumed to come from the income that's going to be paid through from those assets. So property rents, infrastructure income, the coupons paid on credit and debt assets, as was discussed in the training earlier. There is not as much scope for surprise on the upside on returns from income assets, but equally through time, there's not as much surprise on the downside. You expect to earn the income, the coupons, the rents, and therefore you've got a fairly predefined return that you expect to get from those assets. It may be as high as equities, but you assume that you're going to get it with a little bit less return, but there won't be surprise on the upside associated with that. And we're really looking for the return on the overall fund to be a balance of those growth assets and income assets. And that's a combination of long-term return and also long-term sustainability of that return. And then at the bottom, we've got the protection assets, and those really are either protection in a capital sense or protection in a sense of interest rates or inflation moving against you in a way that also affects the liabilities to some extent. It also gives you some liquidity if and as and when there are times that you want to be investing into other assets. So it's not a huge change from the way that we've described assets before, but we're using that grouping of those three types, and that's something that we'll use in future. And as you can see, you're broadly diversified between the growth assets and the income assets. Now, over last year, there were a number of changes that were implemented. The strategy had a series of changes that were agreed, and some of those have been implemented, and some of them are still to be done. A couple of the main changes just to highlight on listed equities, there was a move to introduce the new LGPS Central Passive Climate Aware Fund. So that is just switching some of your passive equities that you previously held with Legal & General into a climate focused and other factor focused fund. So that immediately takes you in some direction to having a more climate climate aware, climate focused fund. It will allocate more towards those companies that are deemed to be climate friendly, and a little bit less exclude some of those that are deemed to be less climate friendly. And that just gives you an overall tilt in your equity portfolio. So that was implemented at the back end of last year. Not a change to the equity allocation amount, but in terms of how it's invested. Carry on through the emerging market debt was switched from the previous investment with Ashmore that was held directly by the fund into an LGPS fund. We also set up an investment grade allocation, a small investment grade allocation, purely on the basis that the spreads you could earn on investment grade bonds relative to the yield that you could earn on index linked gilts gave a little bit of extra return. So it's a relatively small allocation, but again, that was using an LGPS fund that was launched last year. That investment was made in April last year, which was very good timing. That was just post credit spreads having widened, and you've had the significant benefit of that through the 9 months of 2020. The one main change that's still to be implemented in this portfolio from last year, you can see that the multi-asset credit, the target weight is, and that's the liquid sub-investment grade markets, the target weight is 4%. You've only got a very small holding, that's a JP Morgan fund. There is still an intention when LGPS Central launch their multi-asset credit fund, there is a strategic allocation already to invest in that fund, and that will be funded from the targeted return allocation. That leads me on then to where are we at the moment relative to target. You are still, you're a little bit overweight on equities, a bit on listed markets, a little bit on private equity. I'll come back to that. You are overweight on targeted return, and that is waiting for that multi-asset credit portfolio to be launched so that we can fund that from targeted return. We will also, over the year, when LGPS Central launches its targeted return offering, the investment committee will look at that to see if that can be used in place of the existing holdings on targeted return. And again, that just takes you to having more of the assets invested with LGPS Central. You've got underweight in infrastructure and property. I'll come on to property. At the end of the day, property is not hugely attractive at the moment in terms of reasons that everyone will be very well aware of. We'll talk about it in a while. And from that respect, it feels comfortable within illiquid markets. You are overweight private equity, you're underweight property, not looking to change that in the short term. That position, that current allocation can remain in place. The underweight to multi-asset credit I've referred to, and you've also got a holding in cash. And again, part of that cash will be used to deploy assets across to the strategies such as infrastructure, where you need to keep a rolling program running. So that's the main underweights and overweights. If we move on to the next slide, before to move into the strategy recommendations for the year, just a little bit of background and again context in terms of the returns over 2020. At the time of the last valuation, the strategy is set, or the discount rate of the valuation was set at 3.8%. That's basically based on an expected return over gilt yields. But the expected return on the assets was near 5.9% per annum. And that meant that you had that 80% likelihood that the return would be at least 3.8% over a period of 20 years. And that figure, in fact, is in the funding statement that was in the papers earlier. Because of the returns that you've had since March 2019, and indeed some of the changes last year, particularly the reduction in interest rates. So interest rates are pretty much on the floor. We've got talk about having potentially negative interest rates. Our expected return on the assets from October, and it's just to be pretty similar if we were doing the numbers as of December, are actually a little bit lower than that 5.9. Not materially so, but 5.5 against 5.9. And that would suggest that you've got a little bit lower expected return over the next 20 years. In itself, that would suggest a little bit less than that 80% likelihood, perhaps. If we look at the returns you've earned, despite last year having been one heck of a year in terms of markets being very, very down and then having this sort of super returns that they've had over the remainder of the year, the returns to September have actually been 5%. And if I add what I would expect would be your returns over the fourth quarter, which could be another 5%, then actually you've comfortably achieved that 5.9 over the period since March 2019, even allowing for last year being a heck of a sort of bizarre year for markets due to obviously the pandemic and the impact on economies. So we might be a little bit out of kilter in terms of the 80% likelihood. That will depend obviously on when we look at the next actual valuation, but I don't think we're meaningfully off that. And I would also add, before we look into the individual markets, just individual parts of the strategy, a context that markets do not look cheap on the whole. Markets have done very well over 2020, considering the degree of bad news that there has been around both the economy, but obviously also more society in general. And therefore, it doesn't feel like an obvious time to be pushing more risk on the table to try and push the return back up to that 5.9. Markets, there are opportunities. They're not. We're not suggesting returns are awful from here, but it doesn't feel like a time that you really want to be taking additional risk. So much of what I'm going to talk about is really minor adjustments and tilting to the strategy rather than anything more material or significant. I'm going to move on to the individual components now, unless anybody's got any questions at that stage. Okay. On equities, I've talked about the new climate multi-factor fund that you've implemented. That took place in December. That really deals with a lot of the major change to the strategy for the time being within the equity portfolio. You're already invested in the LGPS Central Active Equity Fund and the Active Emerging Market Debt Equity Fund. This would be the new passive component that gives you the climate focus. You have got a number of small passive, regional passive funds that you're now holding, obviously still with Legal and General. One of the things that we recommend the officers and the investment committee do during the year is just have a look at that, see whether there's a way that can be tidied up, simplified, essentially keep the same exposure, but just do it with less funds with Legal and General. That might just make it a little bit neater and tidier. It's not a big deal, but just it's almost just an implementation tidying. On private equity, your strategic allocation is 4.75. You're currently above that. You're currently at 6.1. It's always a moving target. You're never going to be in line. You have to commit to funds. Those funds get drawn down over time. They pay out over time. So you can't get the precise target allocation at any point in time. You have to keep on committing to new funds and recommitting to new funds. That said, we are comfortable at the moment that you actually take a slightly higher strategic allocation to private equity. When we compare it to other illiquid markets such as property, it feels like a reasonable time to be holding private equity. The opportunities from here look broadly attractive to be investing in private equity. So we're not necessarily saying put a lot more money into it, but we're just saying, actually, you know what? Rather than leave the strategic target at 4.75 and not commit to new funds, let's nudge that up to 5.75 and therefore continue to invest in new commitments to maintain the sort of allocation that you've currently got. And that may be through one or two sources. LGPS Central will again be bringing private equity solutions to the partner funds. So we would suggest that the investment committee and officers look at that when available. You have also got Adam Street Partners, who you use for your private equity holding. They will be launching a new secondaries fund. We think there are some attractions in that space, and therefore alongside or as a comparison to the LGPS offering, we think that's also available for the investment committee and the officers to look at during the year. But that's really about maintaining the programme at a level of about 5.75% rather than the current target that's been 4.75%. So a nudge up to private equity. If there's no questions on that, I'll move on to currency hedging and index-linked gilts. The currency hedging piece is, I will absolutely say at the start of this, there is no perfect answer to this. This is one of those where you have to take a little bit of a subjective decision around what it is you're trying to do and what it is that you then do to achieve that. You have currency exposure through both your debt assets, your overseas non-sterling debt, and through your overseas equities. The debt is hedged back, and that's an important aspect in our view. It's hedged back to sterling because you want to earn a yield. You don't want the yield to be lost by currency movement, so that's fine. There's no suggestion of a change there. On the equities, it's really just about, over time, equities will move around purely because of equity volatility, but your return will also move around depending upon what happens to currency volatility. Hedging some of that risk, some of that currency exposure, just dampens the volatility of equities a little bit. Not a huge amount, it's a second order decision, but it dampens that volatility a little bit. And at the moment, you have a strategy in place to hedge half of the currency risk that you have in place with your overseas equity exposure. You could say that's, it's a half wrong, half right. It means you're never going to be completely affected by sterling strengthening, nor completely affected by sterling weakening. You're sort of half and half. And to be honest, that's probably as good a justification of the position that you hold as any. You employ Aegon Asset Management to use their discretion around that 50% benchmark, depending upon where they see the shorter term risks associated with that, to risk manage that currency exposure, which is a very sensible, perfectly sensible strategy, and they've done a good job for you doing that. So we don't propose changing Aegon at all for that. What we have looked at is some of the other aspects other than just reducing currency volatility. and a couple of things in particular. We have looked at whether there is some benefit of having some exposure to non-sterling currencies, given you also have inflation-linked liabilities. So that's looking at the correlation between currencies and real yields. And that would suggest actually there is some benefit of having a little bit more non-sterling exposure, i.e. hedging a little bit less. And we've also looked at the fact that through time, Unfortunately, it's sad to say, but sterling is not the safe currency that it was once considered, the safe haven currency that it was once considered. And indeed, there's a number of charts we've number of periods of time we've included charts in our paper where at times of broader global market stress, sterling has actually not been a better beneficiary of that. Sterling has actually weakened during those times. And those are obviously the very time when your other assets are potentially under stress. And therefore, it seems reasonable to say that that alone would tilt you again more to holding a little bit more non-sterling exposure rather than hedging all of your sterling exposure. They're not huge points, but those two combined, we think it's worth taking the currency hedging program down from a benchmark of hedging 50% of that currency exposure to hedging 30% of the currency exposure. The implementation of it, you'd largely do through Aegon again. Aegon would use their discretion around the timing of that, and that moves to the benchmark. It's not something we'd say, right, sell some of that currency exposure immediately today. I think it's something for the officers to discuss with Aegon Asset Management and implement that, but giving them a window during which to make the change. It's not that we are particularly taking a view there on the relative strength of sterling versus other currencies today. That's obviously moved a little bit over the past couple of months, and we've certainly seen sterling do a little better with the with a deal rather than no deal on Brexit. But we would leave discussions between officers and Aegon about how the timing of the implementation of that change to 30% hedging. But that's the recommendation, the strategic recommendation, to move from 50% to 30%. We'll come back to the summary at the end, so we don't necessarily need to sort of go through each of the decisions as I suggest them. Index-linked gilts and inflation, a smaller point, some of you may be more aware of this in terms of what's been in the press and the headlines on it. We know that the RPI methodology has got problems with it. It hasn't been perfect for a long time, and the government has been has been seeking to essentially move RPI towards something that is a more sustainable calculation methodology. And the decision has been that from 2030, RPI will move to the calculation of CPI, will basically move to CPI. Historically, CPI has been a little bit lower than RPI. So in itself, that would mean that RPI would fall, so index-linked gilts would fall. But interestingly, for local government pension schemes, it means that now index-linked gilts beyond 2030 would actually provide a match for the inflation that you have in the pension increases of benefits. Whereas at the moment, you've had that mismatch between RPI and CPI. If you had a lot of hedging in place, it would be appropriate to maintain that, to think about the sort of having that direct inflation hedging. You don't. The index-linked gilts have been partly held to provide a little bit of inflation hedge, but also because they provide a liquid asset that you can use if you also want to tap into for other investments. At the moment, that fall from RPI to CPI in index-linked gilts would suggest that the implied level of inflation should be falling to something nearer 2% long term. That's government policy. Even with a bit of an inflation premium in there, you might expect implied inflation to fall to something like 2.5%. Implied inflation beyond 2030 is still over 3%. So index-linked gilts, in that sense, are still expensive. They, to my mind, they haven't shifted to allow for the fact that they will be CPI linked in the future, not RPI linked. They've only made a partial move. So to be honest, we think index-linked gilts still look very expensive. We need a little bit of cash to manage that, the currency hedging program. Aegon manage your index-linked gilts, and they manage that cash, the currency hedging program. So we're suggesting making a 0.5% strategic allocation to cash for the currency hedging program. To be honest, they already hold that cash. So we're not looking to move the money. We're just recognizing that Aegon needs some cash to manage that currency hedging program. And we're just taking it from index-linked gilts strategically because we think that's just an expensive asset class for you. Okay, so it's a very, very minor change, but it's really just to get the actual asset or the strategy to tie up with the actual assets that you're holding for currency hedging. If we can move on to the next slide, the other real assets that you hold are infrastructure and property. On infrastructure and property, you're underweight your allocation on both of them. On infrastructure, you need to be committing to new funds, and indeed you made a modest commitment to a JP Morgan fund last year. The allocation is still underweight. We know that the LGPS Central will be producing a new infrastructure fund offering this year, and therefore the logic is that the ISC and the officers look at that fund with an intention to topping up the allocation through the LGPS Central Fund if that's deemed suitable for you to invest in. If not, then I think that just turns it back again to looking at the existing infrastructure assets you've got and making further allocations to those. We certainly don't see any reason why you would want to sustain the underweight position to infrastructure. One wants to ensure that that's built up and committed to through time.
Andy, can I just want to say to the chair, I'm leaving the meeting now, okay?
Thank you very much. Thanks, Councillor Govind.
Thank you, sir. Thank you, bye. Thank you, everyone.
Okay, so I'll just turn to property. Property is definitely the sort of the problem child in the portfolio in terms of where things go from here. That won't be news to anybody. We see that in the press all the time. We have included some additional background material in the paper on property, but let me just sort of summarize it, summarize the position as follows. The retail, the commercial property market that you invest in, commercial property basically encompasses retail, offices, industrial, and alternatives. The retail market has been under pressure for a while, and was absolutely that pressure was accelerated. The transition away from high street retail was accelerated last year. It will be difficult to see how it will come back, certainly come back to anything like where it was. So that does cause some issues for commercial property portfolios, but a lot of that return loss is now baked in. Offices is a more challenging question, a more difficult question to know the answer to. Lots of us are working from home. Lots of companies have started saying, well, actually, more people will continue to work from home in future, and therefore the need for office space won't be as great going forward. So what happens to offices becomes a little bit more uncertain, and it will certainly be geographically dependent and office type dependent. Industrials have done well. Now, ironically, one of the main reasons industrials have done well is not because of industry, but because logistics and the warehouses surrounded with online retail are included within industrials. So actually, I think it's just more of a high street retail flip to logistics around online retail. But industrials have done well. Alternatives have also been growing fairly substantially. So that has been the hotels, leisure, doctors' surgeries, student accommodation. All of those kind of areas have been growing. There's some of them got some challenges around the current pandemic in terms of how they're used. But longer term, those alternatives continue to grow. We think that the transition in broader commercial property or balanced property in which you invest will become a little bit more focused on quality, longer leases, quality tenants. There will undoubtedly also start to be more focus on climate friendly and what are deemed to be good long-term sustainable properties. So there will be more focus on green properties going forward. That absolutely will be an interesting aspect to pick up looking at future strategies. But one of the things that's probably missing from the commercial property portfolios at the moment, and we do think will become more relevant, is the private rented sector, the residential property market, and that becoming part of essentially broader balanced commercial property. As part of that, the return is in development, but part of it is just in the sustainability of longer term rental streams. And there's different sectors of the market there, absolutely different sorts of sectors of the market. So I'm not going to pretend to go into that detail today. Again, I just think that would propose that is for the officers and the ISC when reviewing, looking at property, and then look at residential property as a particular aspect to invest in, but look at the extent to which the LGPS Central property sub-funds incorporate that, what they come up with as part of the offering to you, whether that would actually capture part of that investment. And again, if not, whether there are standalone residential property funds that it will be worth looking at investing in. Quite happy to retain the underweight for the time being. No rush to suddenly get back up to target allocation on property, given that sort of market view I've just given. But we think there is a directional change that it's relevant to encompass. If the LGPS central funds are building that in already, that may be great. That may just be, you can pick that up through using those funds. And that's really for the ISC and the officers to look at through the year, we think. Okay, one just final broad area for me to cover before just summarising and pulling all that together. On credit assets, investment grade bonds, we made the allocation, as I said, in April. That was very good timing. You have an allocation to the LGPS Central Investment Grade Fund. It will be fair to say investment grade credit has become expensive. Those of you who were on the training earlier, you saw the credit spreads on investment grade that are quite tight now as a result of investors sort of pushing yields down. With regard to the currency hedging portfolio, one of the requirements of that currency hedging is to hold a bit of collateral and cash to settle currency movements. And ordinarily you would just hold cash to do that. And I referred earlier to Aegon holding cash to manage that currency portfolio. At a time when we may be moving to negative interest rates, and certainly very, very low interest rates, if not zero, it's also useful to look at, are there areas that a manager can just have the discretion to hold assets that will generate just a little bit of yield rather than cash, which may be no return or negative yield. And the suggestion there is to look at the Aegon also manage a short-dated investment grade corporate bond fund. So think of that as cash is very, very, very short-dated credit. Short-dated corporate bonds will just have a little bit of term to them, so you get a little bit of extra yield pickup. And we think it will be worth, subject to due diligence on that fund, giving Aegon the discretion to hold cash or use that short-dated investment grade fund. I don't particularly think of that as strategic change. It's more that Aegon have a little bit of bandwidth about what they would hold rather than just cash if they think there's some yield opportunity to do so. It is investment grade, it is short dated, so it is absolutely not looking to bounce up the risk. It's trying to just stay in something that is still highly liquid, but just accrues a little bit of extra yield for you. So minor change, more of an implementation issue. Multi-asset credit, we talked about earlier, those who are on the training. I've also referred to the fact that this is already in the strategy. LGPS Central have, they've got that fund, is hopefully going to be launching shortly. Sort of the legwork on that has all been done, the manager's chosen. So subject to the due diligence on that fund, again, that transition, that's an implementation of a strategy change that you have already made last year. The final point, because we're always looking for, are there opportunities over the year that arise that create opportunity for you to invest in? And distressed debt, unfortunately, for all of the reasons that might be not good things to do with the economy and the changes to the way that we are having to live and the pressure that's put on companies, distressed debt will potentially be an opportunity looking forward over the next few years. And the longer we end up with lockdowns on economies, the more pressure that's putting on companies, the more that will create distressed situations. Now, distressed debt investors, a little bit like private equity investors, ultimately are the providers of capital to enable some of those businesses to restructure. So don't think of it as a extracting value where there's and allowing companies to go bust. This is much more around helping companies restructure, providing capital, which unfortunately banks are not providing as much of, providing capital to enable companies to restructure. So there's a positive side to this. You have investments in this space through M&G, through their distressed opportunities fund range. They have made some changes to the team there. So we're not proposing that you jump into that today and put further investment in it, but we suggest that the investment committee, the officers, look at both M&G in the second half of this year and look at that opportunity to potentially allocate more to distressed debt sector in the second half of the year. To be honest, it's not something you desperately need to invest in today, otherwise you'll miss the opportunity. This will be something that will work its way through because that pressure is not going to be alleviated from companies in the next month or two. But we think this may be probably the one area where there is opportunity to actually be investing to get better returns over the next cycle than perhaps you would have had if you were investing there over the last year or so. So that's one that we're just saying that the ISC and officers should look at second half of the year to make investments into either the M&G distressed debt range, and if not, whether there is another means to be able to invest to capture that opportunity. I pulled all that together just on a summary slide on the next page, and really I'll just run through those very quickly and then hand it back out to questions. So the main changes on private equity, we're not looking at necessarily putting significant new money to work, but you are currently overweight that the strategic target of 4.75. We're saying move the target, don't look to actually reduce the allocation. We think it's a good time to move the target up to 5.75, a little bit more in there. And on property, to look at the residential property as a component of your property investment, and to consider both the LGPS offering as part of that, and if not, potentially look at managers who do provide that externally. The multi-asset credit, that fund will launch with LGPS subject to due diligence. We fund that from the targeted return allocation. On private debt, we look at distressed debt in the second half of the year to see whether we can make a further allocation via M&G DOF range. And then on index-linked gilts and cash and credit, just reduce the target allocation to index-linked gilts by 0.5%, and that's really just recognising that Aegon holds some cash to manage that currency programme, and it also gives them discretion to hold a little bit of short-dated corporate bonds as part of that programme. But importantly, the strategic change would be to reduce the currency hedge from 50% to 30% in respect of your international equities. So small changes this year, nothing significant. I don't think this year is a year where you want to be ramping up risk or completely closing down risk. It's a pretty difficult time to be judging where markets are. 2020 actually turned out to be a good year for investments in the end overall. And we're not looking at major strategic changes from here. Thank you. I'll open up to questions and views on the proposals.
Thank you very much, Andy. So if anybody wants to ask a question, could you just use the hand? I notice, Claire, you're the first one.
Thank you, Chair. Andy, a couple of sort of comments, questions for response, please. On the expected returns chart, you commented that the cut in the expected return is relatively small. But in terms of funding rates and combined with the change of the RPI CPI assumption or potential assumption in funding terms, so some of these reduced expected returns, if they feed through to the funding and the actuarial valuation, may be relatively significant on contribution rates, perhaps. So I just wonder whether you would comment on that. I think the reduced returns that we are seeing, I've seen consistently from other providers as well. So I think this is a reflection of the broader economic situation we're in. And secondly, on the currency hedge, I agree with your proposal to reduce the hedge for the reasons you explained, and particularly around sterling being not necessarily a safe haven, so taking hedge off would provide greater protection on the downside in market stress. But Central provided a view on the strategy review in the papers, and they made a comment around the dollar being, or they fear that the dollar may suffer a period of weakness. So I just wondered what your comments were in terms of whether the fund should look to reduce the hedge in a different way for different currencies, or would you prefer to just take it as the overall hedge and take it consistently over the different currencies? Thank you.
Okay, thanks, Claire. On funding, I'm not going to try and second guess the actuary on this one. what I will say is that the assumption that was made for CPI inflation, so that's the inflation that you have in your pension increases, the assumption that was made for CPI at the 2019 valuation was struck by looking at what was RPI inflation less an allowance of what's assumed to be the difference, and the value was 2.3% at that time, which I think broadly fits in with, I think, the comment that I said that the government's got a policy of 2%. You might expect there's a bit of a premium to that, anything up to 2.5%. 2.3 sits in the middle of that range, so that seems plausible. As I say, I'm not going to second guess what they will come up with for the next valuation, but it would seem reasonable to me that it would be a number that's not dissimilar to the 2.3 again. You're not going to get to it by doing RPI less something to get to CPI, but in terms of the absolute value, to me you'd expect to be about the same. So in that regard, I don't think the RPI CPI change in itself should overly influence the value placed on the liabilities for yourselves, nor should it overly influence the value of your assets, because you've got a relatively small holding in index-linked gilts as well. The main driver of those lower returns, as you referred to, Claire, it's sort of fairly widespread in terms of commentary, is the lower interest rates, which last year, basically, obviously, all major economies just slashed their interest rates as a mechanism for supporting economies. We don't expect that to be changing anytime soon. We're not expecting interest rates to suddenly sort of jump back up again, and as a result, you're just keeping those returns all lower. In terms of the probabilities, therefore, on what that does to funding, last year was a good year on returns. So was 2019. So my expectation would be that the funding position is probably still broadly on track. Please do not take that as a funding response with anything other than just broadly speaking, everything seems to be doing what it's expected to be doing. Where there may be a question is obviously if you have got lower interest rates but the same level of inflation, does that put some pressure on the cost of future service? That's a question that I think all pension funds are potentially facing. We will see where things are, obviously, by the time it comes around to the next valuation, but I think that's quite sensibly a question to be discussing with the actuary. That's the first question. Hopefully, Claire, that's given you enough of an answer on that one without me committing too much, because I'm afraid I'm not going to commit on funding.
Thank you, Andy. That's fine. I think it was the point about the future service rate and future contributions rate impact. I think is helpful for the committee to appreciate that. On
currency, you raise a really good point. One of the things that we did when we were going through this analysis was also to look at, should we start having a different strategic allocation per region? Are there significant differences between the US, Europe, and Japan, just taking those as the three sort of broad blocks? And bizarrely, you'd actually look at it potentially the other way around. Sort of, is the US dollar always seen as the ultimate safe haven? So therefore, would you hedge that? The difference between the longer term analysis suggests it's probably not really worth that. It's not worth the complexity of having a different benchmark for each of those regions. And personally, I'm quite happy to have that reduction to 30%, to have strategically more exposure to the dollar still, because of the ultimate safe haven of the dollar. In terms of the short term, yes, has the dollar done well? Will the dollar be under a little bit more pressure from here? That's where Aegon come into their own in terms of managing the mandate. So they will think about whether they think it is appropriate to be in line with that benchmark or retain a little bit more hedging of the US dollar at this point in time. And indeed, I think at the moment, also at the I think at the back end of December, they did, whether they still do or not, I don't know, but I think they were a touch over. So they were holding 60% rather than 50% on the US dollar hedging. So there's an example where they don't just automatically implement the benchmark. They will think about precisely that regional difference and risk hedge accordingly, or hedge the to each of those regions, taking into account what they consider the risks to be. And I would expect that to be the same here. So I would expect them to be applying their judgment as to whether or not they think they would actually hedge more or less of the US dollar depending upon their view on that market at the current time. But that to me doesn't change the strategy. Strategy, I don't see any point in having a different allocation by region.
Okay, thank you very much, Andy. Now I can't see anybody who's, yes, I can do. Nick, you want to ask a question?
Yeah, thank you, Chair. I note the bit about residential property, which I think is an interesting idea. So I await developments on that one. But the question relates to the rest of property. The decline of retail has been sort of well known for a long time. But how much is the down valuation effectively of property that you're sort of suggesting being reflected in existing values, or is there much more, are there further falls to come?
Kat, could you bring up slide 10? So the bottom right hand chart here just shows you the capital value changes.
Yeah.
So and here you can see the retail significantly reduced, office reduced a bit in capital values, but the incomes means that the returns been broadly flat, and the industrial is positive. So that question is whether the sort of a near 20% fall in capital values on retail, is that enough, or has it got further to go? And so I should highlight as well, this is taking retail in its broadest sense. That includes the likes of supermarkets, which will have been seen as having a pretty good year last year, and seen as sort of being strengthening compared with some of the high street. And of course, we all know that there are different sorts of high street retail. Personally, it is one of that's one of the key difficulties in this, Nick. Do you get to a point in a position where tactically it becomes attractive to start buying some of these things again because they've fallen enough? I don't necessarily think we've got there yet. I'm not the property expert. I would expect that level of detail to be sitting with the property managers. I think there is still plenty of concern of the overhang more broadly, that transition towards less retail, coupled with the acceleration of that last year, and obviously a continuation of lockdown. We all know as we walk around high streets that that continues to be a problem. So I think it's probably still got more bad news to come before it hits the floor. The question is then going to be very much about the repositioning of that retail space, because the retail space won't come back necessarily all as retail. Some of it will come back as residential, and that will be part of the interesting transition. But it will need the market to start reinvesting back into making those changes, and that isn't going to happen immediately. So this feels more of a long-term transition. But unfortunately, in the meantime, you're going to have a number of vacant properties sitting there in the retail space, so it doesn't feel like a great place to be sitting. And it requires, as I say, capital to come back into it. And it will require, therefore, liquidity and transactions to take place. At the moment, there's just not a lot of transactions taking place.
What about the office and industrial element of it?
As I said on industrial's been doing sort of great guns, and that's largely to do with the flip side of retail, because it's all been about logistics, and indeed in Leicester being central to England will know that as an area that there's been continued demand and continued rental growth in that space for industrial. Unfortunately, if one looks at some of the traditional industrial, undoubtedly we've got some of those same pressures around sort of how the economy is doing and where the economy is going to go from here. There will be components of industry that are going to end up struggling and needing to change in some way. Office space is the unknown. Most offices, I mean, being realistic about it, companies being able to work from home are therefore continuing as companies, and those companies continue to make money, so they can afford to continue to pay. And if you look at most of the rent collection, from office space has still continued. So that's been fine. Unlike some some areas like some hotels, which city hotels, which haven't been able to necessarily maintain rent payments or retail. The office space is more of that longer term transition. It's not going to happen overnight. Apart from anything else, when we are back into offices, we're all going to have to maintain some degree of spacing and what have you, probably. So they will still need to maintain office space. So the security of decent quality tenant companies on office space, particularly in cities, is still good. It's a longer term transition. Our view about bringing residential into play as part of that broader commercial property is trying to be at the front end of some of that transition, rather than waiting until people are actually really trying to sell office space.
Okay.
Thanks, Andy. Bulesh, you have indicated.
Thank you, Chair. I'll just frame them very quickly for you, Andy. In the past, the fund is allocated to Adam Street's global funds within private equity, but we are proposing this time around to allocate to a secondary fund. Can you just elaborate why you feel that that's more appropriate at this time?
Yeah, and I'll put that into the context of looking at that alongside what LGPS Central offering looks like as well. Because if the LGPS Central offering provides a good investment into private equity, then ultimately that actually may be the easier place for you to make the commitment, and directionally that takes you continues the path towards investing with LGPS Central rather than external managers. The secondaries was more just trying to look at whether there were opportunities that arise from last year, from the pandemic, from COVID, which gives you opportunities. There will be some investors looking to reshape portfolios and exit from investments. Inevitably, market stresses always create those circumstances. In fact, some of the stress was relatively short-lived, but to be fair, we could be about to sort of have a second phase of the market stress as well. We don't know. The secondaries just gives you that opportunity of investing slightly further into that private equity cycle, so you're not on blind investments, and you can get some of that money to work a little bit earlier. And Adam Street will be buying. They're typically buying sort of 4 to 6 years into a program that might be 10 to 15 years long, and they will therefore have visibility of the investments. But they will be potentially being able to buy that at a discount to what they would ordinarily have to pay, because it's not necessarily forced sellers, but it's sellers who are wanting to exit their strategies. The discounts, and there's a comment in the LGPS Central review of our paper, which I think is fair, that the discounts won't necessarily be as big as they were if you look back in 2009, 2010, when there's some real liquidity stress where people needed to get out of positions. But it's that opportunity of being able to buy into known assets at a discount to price. More broadly, and this is why we think it might be a comparison of the Adam Street secondaries, which is the fund that they're raising, and or the LGPS Central offering they come up with. New investments into private equity, per se, this may be reasonable time. Bank lending is not fantastic. Companies are needing capital to get through this next phase. So whether that's be the distressed and the restructuring, or whether that's just as simply as companies all needing to be turning to private equity markets to raise capital, essentially giving up some equity, taking on private equity investment. It's not a bad time broadly for private equity. We think the secondaries is probably just giving you a little bit of an opportunity on return on that.
Brilliant. And just one other thing would have been, what do you think the considerations regarding timing are for moving from 50% currency hedge with Aegon to 30%?
This is definitely one of those how long is a piece of string, because you don't know, and you will only know afterwards whether it was a good decision. I would probably expect to phase it in some way rather than just say, just do it on a day. This is quite a big amount of, I think the size of the program, I think, is 850, equity programs, 850 million. So therefore,
sorry, Andy seems to
they would do,
off.
and they're thinking. Sorry, apologies. I disappeared off. I'm hoping I'm back. I would probably suggest to them that, look, is it sensible to do it over a 3-month period? So you might, or they may say, well, actually, no, we'll do it over 6 months, but something like a 3-month period, and say, fine, we'll go from 50 to 40 to 30, or we'll do it in sort of three stages even, and they move their benchmark accordingly. But they move their positions accordingly. But so that I think should be a discussion with them, so that they aren't surprised by it, and equally they don't suddenly make reactive moves when this is not trying to get market timing precise. So a more gradualistic approach to me seems sensible. Three months would seem like a reasonable time frame, I would have thought.
Thank you, Andy.
Okay, thanks, Bruce. Declan, you had indicated. Declan.
Apologies. Thank you, Chair. Andy, just picking up on Bulish's secondary point, you recommend the Adam Street secondaries. We've obviously got the investment with Aberdeen at the moment. Just wonder why the preference for Adam Street?
Yeah, this is a really nuanced point, Declan. It's a good question. The Aberdeen standard secondaries is even further into the programme, rather than, whereas the Adam Street secondaries is a little bit earlier into private equity programs. So therefore, you still got more of the continued throughput of the work through of what they're investing in. The second is, and this is an important aspect, that what Aberdeen are looking to do is to buy pools of secondaries at big discounts. And some of that may be great, some of that may not be perfect, but because they're getting a big discount, that's why they can get the work through off that. There's not that much liquidity still playing in that market at the moment. What Adam Street Partners will look at is specific investments, potentially holdings in funds of funds they already hold. So investments that they already know, or investments they can see the detail on. So it's typically bigger holdings in a smaller number of investments or a smaller number of funds, and that gives them the visibility of precisely what it is they're investing in at what point in the cycle. So I think, given where we are today, we think the opportunity with Adam Street Partners is probably better timed than more money going into the Aberdeen standard investment, which was more relevant sort of back when at that stage in the cycle when the original investment was made.
Okay, all right, thank you. My other question was kind of Ruffer have got a lot of headlines recently about their sort of their Bitcoin investments. And it's just kind of your view about that really, and their sort of I suppose their approach as a manager.
Yeah, you're right, and I'm trying to find out. I'm trying to find out some more information about that at the moment. So I do not have chapter and verse on that. It's a relatively small allocation. I can't remember what it ends up being. Something like 2% of their funds, something like that. I think of the strategy. And I don't know the background to it. But if you ask me why would it fit with what Ruffer are doing, if Ruffer still have a concern about an inflation-led recession, and they think therefore there will be pressure on all developed countries, economies and currencies, then they will see Bitcoin, I'm guessing, almost as an alternative to gold. And so they will see it as a currency that hasn't got the economic dependency of a developed economy attached to it, which kind of makes it like gold, and therefore it's just another protection fallback asset. That's my expectation, but I don't know, and I'm currently trying to just find out a bit more information on it as well. So it might be something I can come back to you on separately.
Okay, yeah, no, I'd be interested in their view, because they obviously do strange things at different times, don't they, and hold it sometimes for kind of quite contrary kind of reason.
Yeah.
All right, thank you.
Thank you very much. I can't see anybody else indicating they wanted to ask Andy a question. So could I then move on, because the recommendations are set out on page 106. Firstly, you're being asked to approve the recommendation A on the revised strategy asset allocation for the fund as set out in the table within the recommendations. Can I ask you, is that agreed?
Agreed.
Yep, agreed.
Okay, thank you. Secondly, that the investment subcommittee is being asked to consider over the course of 2021 the changes necessary to align the fund's investments with the revised strategic allocation and relevant product launches by LGPS Central and other investment managers. Is that agreed?
Agreed.
And so finally, we're asked to authorise that the Director of Corporate Resources, following consultation with Aegon and the fund's investment consultants, determine the timing of the reduction of the fund's foreign currency exposure within the Aegon currency hedge mandate from 50% to 30%. Is that also agreed?
Agreed.
Agreed.
Okay. Could I then say that then brings the end of the agenda. The next meeting of the committee is scheduled to take place on the 26th of February at the usual time of 9:30. Could I thank everybody indeed for their time, both of officers and of members, and also members of the public who have been watching this online. So could I wish you all a very healthy few weeks until we meet again. Thank you very much indeed. Goodbye.
Bye.
Thank you, Chair. Thank you.
Thank you, Chair.
Bye-bye.